Greetings from Baroda BNP Paribas Mutual Fund. Dividend yield is the ratio of dividend paid out with respect to the share price. Dividend yield funds invest in such dividend-paying companies. Let's explore more about dividend yield funds. Here is an investor who wants to invest in a pure equity fund, but fears the volatility and uncertainty of stock markets. His advisor asks him to put his money in dividend yield funds, as they invest in quality and stable companies that are less volatile than the broader equity markets. Let us understand dividend yield companies through an example. Imagine there are two trees, the apple tree and the mysterious Chinese bamboo tree. In the first few years, the Chinese bamboo tree doesn't seem to be growing at all. But after that, it quickly takes off. In contrast, the apple tree grows gradually, but once fully grown, it yields fruit each year. Dividend-paying companies regularly provide fruits, much like the apple tree. Dividends are a key source of returns, accounting for 1/3 of the overall amount. Dispelling common myths, dividend-paying businesses may come in many sizes, large, mid, or small, can be part of any sector or industry, and can offer both income and capital growth. Why should one invest in dividend-paying companies? Benefits of businesses that pay dividends. To start, they focus on cash flow, which improves financial management. Secondly, as the idle cash is effectively distributed, the dividend-paying companies have improved ROE and ROCE ratios. Thirdly, they offer combined returns from dividend payments and capital growth. Lastly, they offer superior downside protection. Free cash flows tend to have a multiplier effect in the company's share price. Efficient cash flows generate higher returns on capital employed, which helps to generate higher free cash flows, which can be used to invest in better technology and human capital, which may result in better fundamentals. The graph denotes the average number of times these companies have maintained positive free cash flows. Here we have divided the Nifty 500 companies in 10 buckets based on the frequency of dividends paid by them. The first bar on the left shows companies who have paid out dividends in all 10 financial years, that is, with 100% frequency. The next bar denotes companies who have paid dividend in 9 of past 10 financial years, and so on. It is evident from the graph that companies who have higher free cash flows also have higher dividend-paying ability. Companies with effective capital management tend to pay dividends regularly. Buybacks occur when a firm buys back its own shares from current shareholders, usually at a price that is slightly higher than the going rate. Businesses that engage in buybacks also typically have more robust cash flows, stronger fundamentals, and a relatively stable future. There have been buybacks of significant amounts in the past few years, suggesting the potential of higher returns that may be generated through them. The Nifty Dividend Opportunities 50 Index has a lower PE and higher dividend yield compared to the Nifty 500, suggesting better valuations and higher yields. The Nifty Dividend Yield Opportunities 50 TRI has generated higher returns than the Nifty 500 TRI, with lower volatility translating into superior risk-adjusted returns. Nifty Dividend Opportunities 50 TRI has also fallen lesser compared to the Nifty 500 TRI during market. Introducing Baroda BNP Paribas Dividend Yield Fund. The fund aims to help investors build wealth over a long period of time by investing in well-diversified portfolios of dividend-yielding companies. The fund will also consider factors like business fundamentals, management reputation, long-term growth prospects, and financial strength. The fund will select champ companies, that is, companies with history of paying regular dividends and high free cash flows. We will avoid dividend traps. We will look for opportunities across all market caps while seeking reasonably priced growing companies. Furthermore, the fund will follow the Baroda BNP Paribas proprietary BMV framework for finalizing stocks in the portfolio. Here, B stands for long-term sustainability of competitive advantage of the business. M stands for quality of management, and V stands for reasonable valuations. 65 to 100% will be invested in dividend-paying companies, including buybacks. The portfolio will be well-diversified portfolio across sectors and industries. 0 to 35% will be invested either in stocks of other companies and/or high-quality debt and money market instruments. 0 to 10% will be invested in REITs and in VITs. Here's an example of a company that paid regular dividends and maintained positive free cash flows. The multiplier effect of free cash flows resulted in higher sales and PAT growth and higher appreciation in the market price. Here's another example of a company that increased its payout ratio, and there is a stark difference in the company's market price during the two time periods. During the low dividend payout phase, the company has generated flat returns. However, during the high dividend payout phase, the company's share prices picked up. The fund is suitable for investors seeking long-term wealth creation, high-quality, reliable companies, diversification of existing portfolios, and better risk-return trade-offs. This fund is managed by Mr. Shiv Janani, who has an overall experience of 24 years. Baroda BNP Paribas Dividend Yield Fund, an open-ended equity scheme predominantly investing in dividend-yielding stocks. New fund offer opens on 22nd August and closes on September 5th, 2024. Investors understand that their principal will be at very high risk. Investors should consult their financial advisors if in doubt about whether the product is suitable for them. Visit www.barodabnpparibasmf.in or contact your mutual fund distributor to learn more and invest. Mutual fund investments are subject to market risk. Read all scheme-related documents carefully.